So today I want to talk about mortgage life insurance and personal life insurance. We want to compare mortgage life insurance and personal life insurance. Do you know the difference? Do you know which one is better? Do you know which one is cost effective? Do you know which one is beneficial to you or to your family? My name is Yemisi and join me on this topic. You need to know, okay? You need to know. Now, there is a quick question that I have for you. What do you want? Do do you want to protect the mortgage lender or do you want to protect your family? Yes, because that is the question that I need to ask you so that you understand why mortgage life insurance is different from your personal life insurance. So, when you have a mortgage life insurance, it is fantastic plan. Guess what? That mortgage life insurance, the benefit goes to the lender. You might have set up the mortgage life insurance with your broker or with your lender, but you need to know the value it brings to you, and you need to know if there is something out there that is better than the mortgage life insurance. What is mortgage life insurance? It's an optional product that may pay the balance on your mortgage to the lender. God forbid you gain admission to heaven. Now, mortgage life insurance, mark that word, is an optional product, but it is a very good product because if you set up a mortgage and you have amortization period of like 25 or 30 years and you gain admission to heaven, which is also a good thing. But what happens to your family in that house? Are they able to afford the mortgage, or they actually have to go through the process of foreclosure because they cannot afford to pay the mortgage? So mortgage life insurance, during the amortization period, whatever you owe on that mortgage, if life happens, you gain admission to heaven, the outstanding mortgage balance is paid to the lender. That is what happens with a mortgage life insurance, and it is actually optional, but it is good because you want to protect your family financially from having issues with the mortgage. Now, let us proceed to talk about other types of insurance so that you don't get it twisted. Mortgage default insurance is the same thing as mortgage loan insurance. And this type of insurance is compulsory if you want to buy a property and your down payment is less than 20%. Is either you pay it one time or it is prorated over the amortization period. So what is your minimum down payment? Your minimum down payment depends on the value of the property that you want to buy. If it is a $500,000 property, your down payment, minimum down payment is 5%. If you have more, that is fantastic. If you want to buy a property and it is between 500 to 1 million, the minimum down payment varies. The first 500,000 you need 5%, and then the other portion you require at 10%. That is the minimum down payment. If the property you want to buy is 1.5 million and above, you need a minimum of 20% down payment. Now, one thing I need you to understand is mortgage default insurance or mortgage loan insurance is the same thing, right? But it is compulsory if your down payment for that property is less than 20%. Whether you put in 18% or 7% or 10%, so far it is less than 20%, automatically you have to pay for mortgage default insurance. Some companies call it mortgage loan insurance. Now, there are three major companies that offer mortgage default insurance or mortgage loan insurance. We have CMHC, we have Sagan, and we have Canada Guarantee. Those are the three companies that offer mortgage default insurance. Okay. Now, so you need to understand that you can have your mortgage life insurance. If that is what you have currently, you have done well. But mortgage life insurance protects the lender. You have borrowed money to buy a property. If life happens, right, during that amortization period, whatever you owe that lender is paid to the lender because you have a mortgage life insurance. But when you have your personal life insurance, the benefit on that policy goes to your family. Your family can use that benefit to pay off the mortgage, and they might actually have some extra left. So mortgage life insurance and personal life insurance, their objective, or one of the objectives that your personal life insurance would offer you and your family, is it pays off that mortgage if life happens. But the mortgage life insurance, the benefit goes to the lender. That is why you are going to see, number one, the benefit on the mortgage life insurance goes to the lender, but the benefit on your personal life insurance, the benefit goes to your family. Now, the coverage of your mortgage life insurance depends on the value of the mortgage. If your mortgage is 800, the mortgage life insurance is based on 800. But on your personal life insurance, the coverage that you can get depends on your financial needs analysis and on your income, number of kids you have, the current income, and other factors are taken into consideration to determine the maximum coverage that you are entitled to. Now, mortgage life insurance is designed to protect the lender during the amortization period. God, if life happens, you gain admission to heaven, then the mortgage lender is protected. So you have to know that you are protecting the mortgage lender when you have a mortgage life insurance. But when you have your personal life insurance, you can use it as your mortgage life insurance. It serves the same purpose. There are some financial institutions when you want to use them as a lender, when you let them know that, see, I have a personal life insurance, that is what I want to use as my mortgage life insurance, they will accept it. And then you can just assign the policy to them for that amortization period. And afterwards, guess what? The amortization period has ended, the benefit is payable to your family. So I just need you to understand that for your personal life insurance policy, the benefit is payable to your family, and then your family can use that benefit to pay off the mortgage. So that is why I asked you, who do you want to protect? Do you want to protect the lender, or do you want to protect your family? So you can set up your personal life insurance and use it as your mortgage life insurance. So for example, mortgage life insurance is based on the mortgage value. Benefit decreases with time as you pay off your mortgage. Benefit from that policy goes to the lender. Okay, your family or your loved ones do not receive any money from that policy. Mortgage life insurance, let's say Jane Doe has 1 million mortgage life insurance. Yes, and she consistently has been paying her mortgage for 5 years. After 5 years, if she owes just 800,000 on that mortgage, that is what is going to reflect on the mortgage life insurance, because that is her outstanding mortgage debt, and that is what is payable to the lender. God forbid death happens and she gains admission to heaven. Right? There are different types of life insurance in Canada. We have three types of life insurance, and you should work with someone that can explain the three types of life insurance to you without bias, because each of these life insurance have benefits and also clauses. Term insurance is very very affordable. Like it could be as affordable as $50 monthly. It expires. It could be as affordable as $20 monthly, but it expires. So it depends on the term period. If you selected term 10, it expires in 10 years. If you selected term 20, it expires in 20 years, right? If you selected term 30, it expires in 30 years. So if you are a 30 and you set up term 20, at age 50, the policy has expired and you want to renew it at 51. For life insurance for a 51-year-old, of course, it's going to be expensive. But one of the reasons why you need life insurance even at age 65 or 70 is because of the compassionate benefit, is because if it is a policy that has a cash value, you can actually use it when you are alive. Universal life should be set up by an experienced professional, because there are so many factors that must be considered. You should fund your universal life well for it not to terminate. Investment should be monitored at least once a year. Yes. And for whole life insurance, it offers some guarantee. That is why it is the most expensive life insurance. Now, when it comes to setting up your personal life insurance, it is good if you actually combine term insurance and permanent life insurance, because life can be short and life can be long. During this short period of time, there are so many responsibilities, so many debts, mortgage debts, kids' education, car debt, and all of that. So, yes, it makes a lot of sense to actually combine term insurance and permanent life insurance. It is good to combine both coverage. So, guess what? I'm just going to give you this advice. A professional financial advisor or insurance agent should advise you on the three different types of life insurance, tell you the benefit and the clauses. If you encounter anyone that says term insurance is good, whole life is bad, universal life is bad, what they are actually telling you indirectly is they are only licensed to offer you term insurance. So you might actually be in the wrong location. You want somebody that can explain term insurance, universal life, and whole life without bias, and then you get to choose the type of life insurance that you want for yourself based on your budget, based on your risk tolerance, and based on what you want the policy to do for you. For example, if you have a well-funded universal life and you can afford it, right? You did 1 million life insurance. In the first year, it is 1 million. Even at age 100, you're still alive because the policy did not lapse. It is still 1 million that is going to be paid out as a tax-free benefit to your family. Apart from the fact that the accumulated cash value is available for you to use, you can also enjoy compassionate benefits. God forbid there's a terminal illness. If you have a well-funded whole life insurance in Canada, even though you did 1 million in the initial or the first year, till age 100, it is still going to remain 1 million if you have fully funded the whole life of the universal life. So I hope this helps you to make an informed decision. If you want a one-on-one personalized discussion, life insurance is not a one size fits all. Some people will set up term insurance, some will prefer universal life, and I've seen clients that actually prefer whole life. Guess what? I am not biased, and I always tell people about the different types of life insurance so that they can get to choose based on informed information. So if you have 10, it's very affordable. $20 life insurance, but it expires after 10 years. If you set up the policy at age 30, at age 40, it has expired. 41, you need to renew it, and it comes with higher cost. You can set up a personal 10-20 or 10-30 life insurance if you actually want to use it for your mortgage life insurance. But I just need you to understand that it expires. And then if you choose to renew at age 50, age 60, it is expensive at that point. So it is important that you make the right decision at the right time. If you have questions, I will love if you can reach out if you have questions. And it's a privilege to be here. Thank you so much for having me. Have a good day. Thank you.